Imagine this. You wake up on a Monday morning. Your alarm goes off at 6:47 a.m. You drag yourself out of bed, splash some cold water on your face, make a coffee, put on your work clothes, and by 8 a.m., you're already sitting at your desk. You work hard, you show up every single day, you do everything that society told you to do. Study, get a good job, save money. At the end of the month, your paycheck hits your account. And before you even get to touch that money, before you can pay rent, before you can buy groceries, before you can do literally anything with it, somewhere between 25 and 40% of it is already gone. Just like that. Vanished. Taken. No negotiation, no discussion. Just gone. Now picture someone else. He wakes up whenever he wants. No alarm, no commute. He owns 3 properties across 2 states, a stock portfolio worth a few $1 million, and a business that runs entirely without him. He spent last Tuesday on a golf course. At the end of the year, his accountant sends him a document. And on that document, his effective tax rate, 12%, maybe less. You, the person who actually works, who shows up every single day and trades your time and your energy for money, you pay more in taxes than the guy who hasn't worked a traditional job in 15 years. And here's the part that should make your blood boil. This is completely legal, not a loophole someone stumbled on, not a glitch in the system. This is the system working exactly as intended. Welcome back. I'm Max. And today we're going deep on one of the most uncomfortable, most suppressed truths in all of personal finance. How the rich pay less tax than the poor, why the entire system is architected this way, who benefits from keeping you in the dark, and, most importantly, what you can actually do about it starting today. Because the first step to playing the game is understanding the rules. And by the end of this video, you are going to see money, taxes, and the financial system in a way you cannot unsee. Let's get into it. Part 1. The 2 types of income, and why. One is taxed like crazy. Here's the first thing they never teach you in school. And I mean never. Not all income is treated equally by the tax system. In fact, there are 2 fundamentally different types of income, and the government taxes them in completely opposite ways. This single distinction is the foundation of everything we're going to talk about today, so pay attention. The first type is earned income. This is the money you make by trading your time for money, your salary, your hourly wage, your freelance invoice, your bonus at the end of the year. This is what 90% of people on this planet live off. And this type of income is taxed the hardest, by far. In the United States, earned income is subject to federal income tax, state income tax, and payroll taxes, which include Social Security and Medicare contributions. When you add all of that up, honestly, someone earning a decent middle-class salary can easily lose 35 to 45 cents on every single dollar they earn. In France, the UK, Canada, Germany, it's a similar or even worse story. The more you earn from working, the more aggressively the tax system comes for you. The second type is passive income, and this is where the entire game changes. Passive income includes dividends from stocks, rental income from investment properties, and capital gains. The profit you make when an asset you own increases in value and you decide to sell it. And here is the crucial, life-changing difference. In most developed countries, capital gains are taxed at a significantly lower rate than earned income. In the US, long-term capital gains, meaning profits on assets you've held for more than 1 year, are taxed at 0%, 15%, or 20% depending on your total income. Compare that to earned income, which gets taxed at up to 37% at the federal level alone. Let's put real numbers on that. If you make $100,000 from working at a company this year, you might take home $62,000 after taxes. But if you make $100,000 from selling stocks you've patiently held for 14 months, you might walk away with $80,000 or more. Same dollar amount, completely different origin, completely different outcome. And who has most of their income coming from capital gains and dividends? Wealthy people. because they've accumulated enough assets that their money generates more money entirely on its own. Meanwhile, the average working person has essentially zero investment income and is 100% dependent on their salary. This one structural difference alone explains the majority of why the rich pay a lower effective tax rate than the middle class. And I want to be very clear about something. This is not an accident. This is not an oversight. It is a deliberate policy choice, made, maintained, and protected by the people who write the tax laws, many of whom are themselves wealthy investors. Part 2. The step-up in basis. The loophole that lets billionaires die. Tax-free. Stay with me here, because this next section is genuinely one of the most jaw-dropping things in all of tax law. You might assume that even if the wealthy pay low taxes during their lives, at least the government gets its cut when they die, right? There must be some estate tax, some inheritance mechanism, some redistribution that kicks in at death? Well, sort of. But there's a provision so powerful, so quietly embedded in the tax code, that wealthy families use it to pass on virtually unlimited wealth across generations without ever paying capital gains tax on it. It's called the step-up in basis, and once you understand it, you'll never look at generational wealth the same way again. Here's how it works in plain English. Let's say your grandfather bought Amazon stock back in 2001 for $10,000. By the time he passes away in 2024, that stock is worth $4 million. The gain on that investment, the profit, is $3,990,000. Now, if he had sold that stock at any point during his lifetime, he would have owed capital gains tax on that $3.99 million. At 20%, that's nearly $800,000 going to the government. But he didn't sell. He held the stock and died while still owning it. When his children inherit those shares, the IRS does something extraordinary. It resets the cost basis of the stock to the current market value at the date of death. So, in the eyes of the entire tax system, his children didn't inherit stock with a $10,000 cost basis. They inherited stock with a $4 million cost basis. The $3.99 million gain, nearly 4 decades of compounding appreciation, is simply erased, wiped clean, as if the profit never existed. If the children turn around and sell the stock the very next day, they owe zero capital gains tax. Nothing. On nearly $4 million in profit. This is not some exotic offshore scheme. This is standard mainstream estate planning for wealthy American families. It is legal, widely used, and defended aggressively by lobbyists every time a politician proposes reforming it. And the reason the middle class doesn't benefit from it meaningfully is simple. They don't hold millions of dollars in appreciated assets to pass down in the first place. The wealthy do. And so the step-up in basis functions, in practice, as a multi-generational tax break disguised as a technical accounting rule. Part 3. Buy, borrow, die. The strategy. Wall Street doesn't advertise. Now, here is where the whole thing becomes almost surreal. We've established that selling assets triggers capital gains tax. So, what do the genuinely ultra-wealthy do to avoid ever triggering that tax? The answer is devastatingly simple. They never sell. Instead, they use their assets as collateral to take out massive loans. Tax-free loans that can fund an entire lifestyle. Think about it. Elon Musk, Jeff Bezos, Mark Zuckerberg, Larry's, Ellison. The majority of their wealth exists on paper, in the form of stock in the companies they founded or control. They don't have tens of billions sitting in a bank account somewhere. But they also don't need to sell a single share to live extraordinarily, because banks, perfectly rationally, will lend them hundreds of millions of dollars against those shares as collateral. And the interest rates they get? Far lower than what you'd pay on a mortgage, because the bank knows those shares aren't going anywhere. Here's the beautiful or maddening Bishop part. Loans are not income. The IRS does not consider borrowed money to be taxable income. Full stop. So, when a billionaire takes out a $500 million line of credit against his stock portfolio, he owes zero income tax on that $500 million. He uses it to fund his lifestyle, make philanthropic investments, buy assets, whatever he wants, and his stock continues to appreciate untouched in the background. This strategy has a name that's become well known in financial circles: buy, borrow, die. And it's exactly as straightforward as it sounds. You buy assets, stocks, real estate, businesses. You borrow against those assets rather than selling them, giving you cash to live on while your wealth continues to compound. Then, eventually, you die, which triggers the step-up in basis we just discussed. Your heirs inherit the assets at their stepped-up value, immediately sell at zero capital gains tax, and use those proceeds to pay off whatever loans remain. The entire life cycle of that wealth, from initial accumulation to final inheritance, unfolds with minimal tax exposure at every single stage. Meanwhile, an employee earning $85,000 a year has no version of this available to them. Every dollar they earn is taxed before they receive it. There is no equivalent strategy. The game is simply not being played on the same field. Part 4. Corporations, deductions, and the art of making income disappear. Let's talk about something that will completely change how you think about business expenses. One of the most powerful legal advantages available to wealthy individuals is the ability to route significant portions of their lifestyle through a business structure. When you own a business, even a relatively small one, you can legally deduct a wide range of expenses from your taxable income before you ever pay a dollar of tax on it. A business owner can potentially deduct the cost of a vehicle used for business, a home office, client meals at restaurants, travel to industry conferences anywhere in the world, online courses and education, a portion of their phone bill, health and life insurance premiums, retirement contributions well beyond what a regular employee can access, equipment, software, subscriptions. The list is extensive and legitimate. None of this is cheating. But the cumulative effect is dramatic. It dramatically reduces the amount of income that even gets counted as taxable in the first place. Consider two people, each generating $200,000 in revenue this year. The first is a salaried employee. She pays income tax on the full $200,000, minus the standard deduction, essentially the full amount. The second runs his own business and earns the same $200,000 in revenue. After legitimate business deductions, office, equipment, travel, insurance, retirement, his taxable income might sit at $120,000 or even less. She pays tax on $200,000. He pays tax on $120,000. Same lifestyle, drastically different tax bill, fully legal, and as you climb the wealth ladder, these strategies compound aggressively. Wealthy real estate investors use depreciation, a paper loss that lets them offset real taxable income, even when the property is simultaneously increasing in actual market value. That's not a typo. You can collect rental income, watch your property appreciate, and still show a tax loss, all at the same time. Wealthy individuals establish complex trust structures that move assets out of their taxable estate. They use charitable foundations that generate a personal tax deduction while still allowing them to direct how the money gets deployed. The tax code is an enormous puzzle, and the wealthy can afford the teams of accountants, tax attorneys, and financial planners needed to solve that puzzle optimally. The average person working a 9-to-5 simply cannot. So the gap between what the rich pay and what everyone else pays continues to widen, not because the wealthy are smarter, not because they work harder, but purely because they have access to a fundamentally different set of tools. Part 5. The Payroll Tax Cliff. How the system actively punishes the middle class. I saved this one for here because it might genuinely be the most enraging part of the entire conversation, and almost nobody in mainstream media talks about it directly. In the United States, there's a tax called the payroll tax, specifically the Social Security contribution. Every working American pays 6.2% of their wages towards Social Security, and their employer matches that with another 6.2%. So, between employee and employer, 12.4% of every wage dollar goes to fund Social Security. Here's the catch that changes everything. This tax only applies to the first $168,600 of income in 2024. After that threshold, the Social Security payroll tax simply stops applying. It disappears. It does not exist for every dollar earned above that number. Think about what this means in practice. Someone earning $50,000 a year pays Social Security tax on 100% of their income. Someone earning $168,600 pays it on 100% of their income. But someone earning $5 million a year, they pay Social Security tax on just the first $168,600, which represents roughly 3.3% of their total income. The effective Social Security tax rate therefore decreases as income increases. The more you earn, the smaller the percentage of your total income that gets hit by this tax. A middle-class worker at $80,000 a year pays a higher percentage of their entire income in payroll taxes than a millionaire does. This is called a regressive tax, one that takes proportionally more from people who earn less. And this is not buried in fine print or hidden in an obscure provision. This is official, public, openly debated tax policy. It has been this way for decades. It is defended every single time a lawmaker proposes removing the cap. The arguments against removing it are always economic, but the people making those arguments are, in many cases, the same people who benefit from the cap staying exactly where it is. When you layer this on top of capital gains advantages, the step up in basis, the buy, borrow, die strategy, and business deductions, you stop seeing the tax code as a neutral technical document. You start seeing it for what it is, a system that has been shaped over decades to favor the accumulation of capital above the compensation of labor, to favor those who already have assets over those who are still building them. Part 6. What you can actually do about it. All right, I know that was a lot to process, and I know some of you watching right now are frustrated, maybe even genuinely angry. That is a completely understandable response to everything we just went through. But here's where I want to leave you, because this video was never about making you feel helpless. It was about handing you the map that most people never get. Because here's the truth that actually matters. Most of these principles are not exclusive to billionaires. The strategies behind them are available to regular people at a human scale. And the earlier you start applying them, the more powerful the compounding effect becomes over time. Invest, even if it's small. The goal is to begin building assets that generate passive income. Income taxed at a fraction of what your salary is taxed at. Index funds, ETFs, dividend-paying stocks. These are accessible to virtually anyone with a brokerage account. The amount matters far less than the habit. Every month you delay is a month your money isn't working for you and being taxed at the lower rate. Max out your tax-advantaged accounts. In the US, this means your 401k, your IRA, and your HSA if you're eligible. These accounts allow you to invest money either before it's taxed at all or in a structure where future gains are completely shielded from taxation. This is the closest legal equivalent to a tax loophole that's accessible to regular people. And the majority of people either don't use them at all or don't contribute anywhere near the maximum. Consider building a side business, even a modest one. The moment you have a legitimate business, you gain access to a category of deductions that simply do not exist for employees. That doesn't mean inventing fake expenses or pushing any ethical boundaries. It means understanding what legitimate business costs look like and structuring your financial life to take advantage of them fully and legally. Hold your investments long-term. Patience is itself a tax strategy. Holding an asset for more than 12 months before selling shifts your tax treatment from ordinary income rates to long-term capital gains rates. That single decision, simply waiting, can materially reduce your tax burden on investment profits without any complex planning required. Continuously educate yourself. The wealthy don't just have money. They understand how money works at a level of depth that most people never reach, usually because nobody ever taught them. Books, qualified financial advisors, channels like this one. Every piece of genuine financial knowledge you accumulate is a direct weapon against a system that profits from your ignorance. The rich pay less tax than the poor not because they're smarter, not because they work harder, not because they deserve it more, but because they understand a set of rules that most people never even knew existed. And they apply those rules consistently across their entire financial life, year after year. Now you know the rules. The question is, what are you going to do with that? Tell me what video you want me to make next. See you soon.